Good morning, guys. Welcome to Mug Briefing. Rivian just told investors it now expects to deliver about 62,000 to 67,000 vehicles in 2026, a marked step up from roughly 42,000 cars it sold in 2025. At the same time, the company said production of its lower-priced compact SUV, the R2, will begin in the second quarter of 2026 at its Normal, Illinois plant on a single shift, with a second shift to be added later as volumes prove out. Those two facts, higher overall deliveries and a concrete launch window for the R2, are what moved markets and make this moment worth your attention. Here's exactly what happened. Rivian updated its 2026 delivery guidance and walked investors through how it expects to reach that number. Management's public materials and the earnings call set the 62,000 to 67,000 vehicle range as the company's guidance for the year. They also described the R2 plan: start production in second quarter at the Normal, Illinois factory on one shift, add a second shift later in the year as ramping allows, and expect the R2 to make up a material slice of the year's growth. Public commentary has pointed to roughly 20,000 to 25,000 R2 deliveries in 2026 as the company's working estimate. Executives flagged that launch costs and added complexity will weigh on margins in the near term, and they offered ranges for adjusted EBITDA loss and capital spending tied to the ramp. Why now? A few practical causes line up. Rivian is moving from a lower volume base toward a mainstream price point with the R2, and management wanted to give investors a clearer picture of how that shift will affect the company's numbers for 2026. Announcing higher guidance during an earnings cycle helps reset analyst models and can calm markets if the company believes operational steps, parts supply, factory readiness, staffing plans are sufficiently in place. It's also the logical time to be transparent. The R2 ramp is a big, company-wide effort, and investors expect an update once launch timing and capacity plans firm up. What this likely means is straightforward and mixed. If Rivian executes to plan, the company will meaningfully increase volume and reach closer to mainstream EV buyers through a lower-priced model. That improves the pathway to scale and, eventually, better per-vehicle economics. Supporters will say this shows discipline. The company is managing a controlled ramp, single shift first, rather than promising immediate mass production. Critics will point out the risks. New launches almost always depress margins at first, and the company signaled that automotive gross margin will be weaker in the quarters where the R2 is ramping. How Americans could feel the effects? Buyers may see a Rivian option closer to the mid-price SUV market in 2026, with reported starting prices around the mid-$40,000. That increases choice and could nudge competitors on price and incentives. Workers in and around the Normal, Illinois area should watch hiring announcements and supplier activity. The single shift start implies staged hiring and more employment as the second shift comes online. For investors, the update resets expectations. Higher volumes are positive, but the company also warned of near-term cash burn and elevated capex, so the path to consistent profitability remains conditional on the ramp's success. It helps to be precise about what's confirmed and what's interpretation. The 62,000 to 67,000 delivery range is company guidance. Rivian set that target. The company's comments that the R2 could account for roughly 20,000 to 25,000 of those deliveries have been reported repeatedly, but that number sits more in the category of management projection and media interpretation, rather than a legally binding guarantee. Rivian published timing, second quarter start, single shift, but it did not promise a fixed daily production rate or an immediate second shift. That second shift is conditional on how the ramp proceeds. Margin pressure and adjusted EBITDA and capex ranges were presented as guidance ranges, not precise forecasts. and the market's stock reaction reflects investor interpretation of those numbers and the implied path toward scale. Rallies were driven by optimism, not by any new guarantee of immediate profitability. Who benefits and who takes the risks? Existing shareholders can benefit from the higher guidance if the company executes, since higher volumes generally justify higher valuations. Suppliers gain new business, but also shoulder the risk of making capacity investments timed to Rivian's ramp. Local workers stand to gain jobs, though early hiring may be tentative and tied to how quickly a second shift activates. Competitors could lose share if Rivian executes well in the mid-price SUV field, but Rivian also exposes itself to higher cash burn if demand falls short or if ramp issues arise. What could realistically happen next? The most likely realistic scenarios are a controlled ramp with most R2 volume coming in the back half of 2026, or a slower ramp if suppliers or quality checks delay a full second shift. Management could revise guidance later in the year if supply constraints, demand shifts, or margin pressures change the picture. Worst-case realistic risks include supplier failures that slow output or larger-than-expected margin hits during the launch quarters, which would force the company to re-evaluate spending and timelines. What this does not mean? Higher guidance isn't the same as immediate profitability. It doesn't prove demand for the R2 will be ironclad, nor does a stock rally by itself validate the strategy. A second quarter start does not mean full-scale production from day one, and it is not a sign that the broader EV market has definitively turned around. This is a company-specific execution story. If you want to follow the story, watch the monthly and quarterly delivery reports, hiring notices at the Normal, Illinois factory, supplier announcements or plant expansions, and any updates to CapEx or margin guidance from management. Those are the concrete signals that will show whether the R2 is unfolding as Rivian expects, and whether the higher 2026 guidance turns into reality or needs to be revised. In short, Rivian has set a clearer, more ambitious target for 2026 and given a reasonable, staged plan to get there. The upside is meaningful, but it hinges on a careful, complex launch, and the next few quarters will tell whether the company can make the plan real.